All right, guys, welcome back. Welcome to FinQuiz, folks. Let's settle in. Today, we're going to talk about introduction to risk management. And before anyone panics, no, this is not going to be one of those lectures where the formulas start chasing you across the room. We'll keep it simple, relaxed, and practical, like we're just talking through how smart investors actually think. So this is the last learning module in portfolio management, and honestly, it's a perfect place to end this topic area. Because after all the work we've done on portfolios, diversification, asset allocation, risk and return, behavioral issues, now we come to the big practical question. How do we actually manage risk? And notice something here. The topic is not called how to eliminate risk. It's called risk management. Big difference, because in finance, risk is not the villain. Poorly understood risk? Yup, that's the villain. Unmeasured risk is the villain. Risk taken blindly, emotionally, or without a plan, that is the problem. Risk you don't understand, risk you don't measure, risk you take just because last year went well, that's the dangerous stuff. So, risk itself? Risk is part of investing. It's part of business. It's why investors expect returns in the first place, because if there were no risk, there would be no real reward. Everybody would just put money somewhere, relax, and say, okay, wake me up when I'm rich. Obviously, not how the world works. In the real world, interest rates move, stock prices fall, currencies jump around, companies miss earnings, borrowers default, regulations change, and sometimes something totally unexpected hits the market, and suddenly everyone becomes a risk expert after the damage is already done. So the basic idea is this. Risk management means we identify risk, we measure risk, and then we manage it so it stays aligned with our goals. Not panic, not guessing, not avoiding everything, just a disciplined way of saying, okay, what can go wrong? How serious could it be? And what should we do about it? Think about an airline. One major risk is fuel price risk. If oil prices go up, the airline's costs go up, profits may fall, and investors may not be too happy. Now, the airline cannot call the oil market and say, hey, please behave this quarter. We have shareholders to impress. That would be nice, but no. What the airline can do is identify the exposure, measure the possible impact, and then decide whether to hedge, adjust ticket prices, change routes, or accept part of the risk. That's risk management. Same idea for a portfolio manager. A portfolio manager cannot control the market. You can't tell the S&P 500, please don't drop this week. My clients are already nervous. Markets don't care. But the portfolio manager can control exposure. How much equity risk, how much bond risk, how much currency risk, how diversified is the portfolio. And that's why good risk management improves value, returns, and decision quality. Now, quick exam warning here. Good risk management does not mean losses will never happen. A good portfolio can still lose money in a market crash. A strong company can still suffer in a recession. Risk management is not a magic shield. So what it does is help decision makers prepare before the bad event happens. A weak risk process is shocked by everything. A good risk process may still face shocks, but at least the possible damage has already been discussed, measured, and planned for. Now let's bring in the role of the portfolio manager. First, portfolio managers use risk management to improve the risk-return trade-off. And that's such a CFA idea, right? We don't just ask, what return did you earn? We ask, how much risk did you take to earn that return? Now, folks, just remember, two portfolios may both earn 10%, but one may be diversified and disciplined, while the other may have made 10% by taking one huge risky bet and just getting lucky. Same return, very different quality. Now, second is portfolio managers also have to understand enterprise risk, meaning the risk of the firm itself. An investment firm can face regulatory risk, operational risk, reputational risk, cyber risk, employee misconduct risk. All of that matters. So risk management is not only about client portfolios. The business itself has risks too. Third, portfolio managers evaluate risk in the companies they invest in. When you buy a company's stock or bond, you are buying exposure to that company's risks, right? Like a bank has credit risk, an airline has fuel risk. A tech company may have product risk, competition risk, or cyber risk. So a good analyst is always asking, what could go wrong here and how bad could it get? Now, institutions and individuals manage risk differently. Institutions usually have formal systems, boards, risk committees, models, limits, reports, dashboards, the whole corporate setup, very organized. Sometimes too many meetings, but still, there is a system. Individuals, on the other hand, often manage risk informally and reactively, and that's very human. Many people start saving seriously after losing a job. They buy insurance after seeing someone close face a medical emergency. They learn diversification after one favorite stock falls badly. Before that, they may say, no, I know this company, it's safe. Famous last words in investing, but the principle is the same for both institutions and individuals. The goal is not to avoid all risk. The goal is to select the right risks. If a company avoids every risk, it may never grow. If an investor avoids every risk, they may not earn enough return to meet long-term goals. And if a CFA candidate avoids every difficult topic, well, you already know what happens. CFA Institute has a very special talent for finding the thing you skipped, right? So risk should be part of every strategic decision, not added later as a tiny footnote saying, by the way, this could destroy us. No, risk belongs in the main discussion. If a company expands into a new country, it should think about currency risk, legal risk, political risk, and operating risk before making the move. If a pension fund changes asset allocation, it must think about liabilities, liquidity needs, and market risk. If an employee invests heavily in employer stock, they need to think about concentration risk because their salary and investments may both depend on the same company. And when risk management is done well, the outcome is usually better long-term performance. Not perfect performance, of course, and not zero losses, but better decisions, fewer surprises, stronger discipline, and a better chance of reaching goals. So here's the big takeaway from this introduction. Risk is unavoidable. Unmanaged risk is optional. We cannot remove uncertainty from business or investing, but we can identify it, measure it, discuss it, and manage it. And as you study this reading, don't treat it like a boring list of definitions. Think of it like a decision framework. What are the goals? What risks are being taken? Are those risks understood? Are they within tolerance? Should we accept them, reduce them, transfer them, or shift them? That is the story of this learning module. All right, so that's our introduction. Risk management is not about running away from risk. It's about choosing the right risk, managing it intelligently, and making better long-term decisions. Now, before we move on, the summary you're seeing on screen is from the FinQuiz Battle Ready summary. And the reason we use this format is simple. Close to the exam, candidates usually don't need more noise. They need structure. They need something that helps them see the full reading at a glance, remember the flow, and quickly revise what CFA Institute is likely to test. So if you feel this kind of clean, exam-focused structure helps you study faster, you can download the Battle Ready summary through the link in the description. Use it alongside the curriculum, practice questions, and mocks. Not as a shortcut, but as a way to keep the reading organized in your head when revision time gets tight. All right, now let's move to the actual risk management process. Now, this is where the module starts becoming more practical. In the introduction, we said risk management is not about avoiding risk. It is about choosing the right risks, understanding them, and managing them properly. Now, CFA Institute takes that idea and turns it into a process. So first, let's define risk in a very clean way. Risk is exposure to uncertainty that can lead to a potential loss. Now that sounds simple, but don't rush past it. The word uncertainty is doing a lot of work here. Risk exists because the future is not fully predictable. We do not know exactly what interest rates will do, what stock prices will do, what customers will do, what competitors will do, or what governments will do. And honestly, if anyone tells you they know exactly what will happen in markets, either they are joking, selling something, or very confidently wrong. So risk is not just the loss itself. Risk is the exposure to an uncertain outcome. The loss may happen or it may not happen, but the possibility is there. For example, if a company has debt with a floating interest rate, it is exposed to interest rate risk. If rates rise, interest expense increases. If rates fall, maybe the company benefits. The uncertainty is the risk driver. The company's debt position creates the exposure, and that brings us to the key insight on your screen. Returns are uncertain, but risk exposure can be managed. So this is very important for level 1. A portfolio manager cannot fully control return. A business cannot fully control sales. A bank cannot fully control defaults, but they can control how much exposure they take. So let's say a portfolio manager can decide whether to hold 80% equities or 40% equities, right? A company can decide whether to hedge currency exposure. A bank can decide how much lending it wants in a risky sector. An individual can decide whether to put all savings in one stock or diversify. So risk management is about controlling the exposure because the final outcome is never completely under our control. Think of it like driving. You cannot control every other driver on the road. You cannot control the weather. You cannot control whether someone suddenly brakes in front of you, but you can control your speed, your distance, your seatbelt, your route, and whether you are texting while driving. Please don't do that, by the way. That is the idea. You cannot remove uncertainty, but you can manage your exposure to it. Now let's talk about risk exposure. Risk exposure means the degree to which an entity is vulnerable to underlying risks in the market or environment. In plain English, it means how badly can this risk affect you? Two companies may face the same risk driver but have very different exposures. Suppose oil prices rise. For an airline, that may be painful because fuel is a major cost. For an oil producer, rising oil prices may actually be good news. Same risk driver, very different exposure. Or think about exchange rates. A local grocery store selling only in one city may not care much about the euro or yen, but a multinational company earning revenue in different currencies may care a lot. Again, same market movement, different exposure. So in risk management, we are not just asking what can happen. We are asking how exposed are we if it happens? That is a very CFA way of thinking. Now, what does risk management actually involve? First, we measure and understand the risk. And notice the order. We cannot manage what we have not understood. If a company says we have some currency risk, but we're not sure how much, that is not good enough. A serious risk process tries to quantify it. How much could cash flow change? How much could profit fall? How much could portfolio value decline? Second, we decide the level of exposure and the rationale. This is important. Risk exposure should not be accidental. Management should be able to explain why the organization is taking that risk. For example, a company may say, we are accepting some commodity price risk because hedging is too expensive and our balance sheet can absorb the volatility. That is a rationale. But if the answer is, we didn't really think about it, then that is not a risk management process. That is just hope wearing a tie. Third, we adjust or mitigate exposure to optimize outcomes. Sometimes that means reducing risk. Sometimes it means hedging. Sometimes it means diversifying. Sometimes it means transferring risk through insurance. And sometimes, interestingly, it may even mean increasing risk if the current exposure is too low for the return objective. So risk management does not always mean take less risk. It means take the appropriate amount of risk. Now, the fourth one is we continuously monitor and modify. This is very important because risk is not frozen in time. It changes. A portfolio that was balanced 6 months ago may become too equity heavy after a stock market rally. Similarly, a company that had manageable debt may become stressed if interest rates rise. Or a bank that had safe loans may suddenly face higher credit risk if the economy weakens. So risk management is not one meeting, one spreadsheet, one report, and then everyone goes home happy. No, it is continuous. You identify, measure, monitor, and adjust. Then you do it again and again because markets move, companies change, and life happens. Now let's walk through the process steps shown on your screen. Step 1 is identify risks. Now, this is where we ask, what risks do we face? Like market risk, credit risk, liquidity risk, operational risk, legal risk, currency risk, interest rate risk. For individuals, maybe health risk, income risk, longevity risk, you name it. Now, once risks are identified, we need to estimate the size of the exposure. A risk that sounds scary may be small in actual dollar impact. Another risk that sounds boring may be huge. So measurement matters. Let's say a bank owns a large bond portfolio. The risk manager may ask, if interest rates increase by 1%, how much money could we lose? This is where risk becomes more concrete. It moves from, rates might rise to, okay, if rates rise, we may lose $10 million. Big difference, right? One is a worry. The other is a number. Now, step 3 is qualitative evaluation. Not everything can be perfectly measured. Some risks require judgment. Where does the risk come from? How does it affect the business or portfolio? Is it internal or external? Is it controllable or not? Is it rare but severe? So here we ask, where is this risk really coming from? Suppose a company has high sales, but most of its sales come from one big customer. On paper, the numbers may look fine, but qualitatively, that is risky. If that one customer leaves, the company suddenly has a serious problem. So this step is less about calculators and more about judgment. It is the use your brain, not just Excel part. Okay, now let's talk about analyzing the environment, especially risk drivers. A risk driver is the underlying factor that creates risk. Interest rates, exchange rates, inflation, regulations, customer behavior, technology changes, economic growth, these are examples of drivers. In simple words, here we zoom out and ask, what is happening around us? For example, a portfolio manager may look at inflation, interest rates, oil prices, elections, recession risk, or central bank policy. Think of it like checking the weather before leaving home. You may be perfectly dressed, but if a storm is coming, you still need to know. Same thing with portfolios. Even a good company can get hit if the economic environment changes badly. Now, step 5 is analyze business or portfolio exposures. Here we connect the outside world to our actual position. If rates rise, what happens to our bonds? If the currency changes, what happens to our cash flows? If the economy slows, what happens to our borrowers or portfolio companies? We ask, where exactly are we exposed? Imagine a portfolio that looks diversified because it holds 40 stocks. Sounds safe, right? But then you check properly and realize 25 of those stocks are technology companies. Okay, so maybe it is not as diversified as it looked, or a company may think it is doing business globally, but most of its revenue actually depends on one currency or one country. That exposure matters. And next one is monitor changes. Because exposure today may not be exposure tomorrow. Risk can increase quietly. Sometimes nothing looks dramatic until suddenly the numbers are outside tolerance. Like a borrower who looked safe last year may become risky this year. A company with strong earnings may suddenly face higher costs. A calm market may become volatile after one central bank announcement. So monitoring is basically saying, don't fall asleep after making the plan. Risk management is not a one-time selfie. It is more like a live video. Now the last one is apply risk metrics and stress or scenario analysis. This is where we use tools. Metrics may include standard deviation, beta, value at risk, duration, credit measures, and there may be other risk measures. Now, stress testing asks, what if something extreme happens? And scenario analysis asks, what if a specific combination of events happens? For example, what if interest rates rise, equity markets fall, and liquidity dries up at the same time? That kind of thinking is powerful because in real crises, risks often arrive together, like uninvited guests who all show up at the same dinner. Okay, now let's simplify the whole process. Risk management is basically a loop. Identify the risk, measure the exposure, decide whether the exposure is acceptable, then modify it if needed, and monitor it continuously. That is the core. And for exam purposes, remember, risk management is not about minimizing risk. CFA Institute is very clear on that. The goal is to take well-understood, chosen risks that help maximize value for a company or portfolio or utility for an individual. So if the exam asks something like, which of the following is the goal of risk management? And one option says, eliminate all risk or minimize all risk. Be very careful. That sounds safe, but it is usually not correct. The better answer is usually about defining, measuring, managing, and aligning risk with objectives. So folks, remember, risk cannot be fully avoided and return cannot be fully controlled. But risk exposure can be understood, measured, and managed. And that is what separates disciplined decision-making from gambling with better vocabulary. All right, now that we understand the risk management process, we are ready to move into the risk management framework. Basically, the structure, infrastructure, people, systems, and governance that support this whole process. All right, risk management framework. Now, don't let the word framework scare you. In CFA readings, whenever you see the word framework, it usually just means what structure do we need so this thing actually works? So risk management is the idea. The framework is the setup that makes the idea practical because it is very easy for a company to say, we manage risk. Okay, great. But how? Who is responsible? What systems are used? Who measures the risk? Who reports it? Who decides whether the risk is too high? What happens if the exposure is outside the limit? Who gets the phone call when something starts going wrong? That is what the framework answers. So in simple terms, a risk management framework is the infrastructure, processes, and analytics that support effective risk management. Think of it like a hospital. The goal is to treat patients, but to actually do that, you need doctors, nurses, machines, records, procedures, emergency rooms, reporting systems, and decision rules. Without that structure, good intentions are not enough. Same thing in risk management. Saying we care about risk is not enough. You need a system that turns that concern into action. And the first big point here is that risk and return must be considered together. This is so important. A company should not make a decision by only asking, how much money can we make? It should also ask, what risk are we taking to make that money? A portfolio manager should not only ask, what return can this investment generate? The better question is, what return can this investment generate for the risk we are taking? Because high return alone can be misleading. Sometimes high return is skill. Sometimes high return is just hidden risk smiling at you politely. And hidden risk is usually very polite right before it ruins your day. So the framework should force decision makers to consider risk and return together in all major decisions. Now, another important point, the framework should be tailored to the organization's goals. This is not one size fits all. A large global bank needs a very different risk framework from a small investment advisory firm. A pension fund needs a different framework from a hedge fund. An individual saving for retirement needs something different from an insurance company. You do not just copy another organization's framework and say, they look successful, let's use their risk system. That is like borrowing someone else's prescription glasses and saying, well, they can see clearly, so I should be fine too. No, the framework has to match your own objectives, risks, size, resources, and complexity. Now, here you can see the key factors in a risk management framework. We have risk governance, risk identification and measurement, risk infrastructure, policies and processes, risk monitoring, mitigation and management, communication, and strategic analysis or integration. Now, let's walk through these. First, risk governance. Risk governance is the top-level direction. It is usually a board-level responsibility. The board or governing body sets the tone. It defines the organization's risk tolerance and provides oversight. In simple language, governance answers questions like, how much risk are we willing to take? What risks are acceptable? What risks are not acceptable? Who has authority to make risk decisions? How do we make sure management does not take the organization outside its risk limits? So risk governance is not just paperwork, it is the foundation. And this is very exam relevant. Governance is not mainly about day-to-day trading decisions. It is about top-level oversight, risk tolerance, and making sure risk management supports enterprise objectives. For example, a board may say, we are willing to take business risk in our core market, but we do not want large currency exposure. That guidance then affects management decisions, hedging policy, capital allocation, and reporting. Now, many organizations also have a risk committee. So this committee provides a regular forum to discuss key risk issues. It helps bring risk into the normal decision-making process instead of treating it like something separate. Because if risk is discussed only after something goes wrong, that is not risk management. That is damage control with a meeting agenda. Next, let's talk about enterprise risk management, or ERM. Now, in simple term, enterprise risk management means we look at the whole organization, not just one part. So this is a big idea. A company should not manage one department's risk in isolation while ignoring how it affects the rest of the business. For example, if we talk about a pension fund, A pension fund should not look only at assets and ignore liabilities. Similarly, a bank should not only look at loan returns and ignore liquidity or capital risk. So, ERM takes a holistic view. It looks at assets and liabilities. It looks at business risk, financial risk, operational risk, and strategic risk. It asks, how does all of this affect the health and value of the entire organization? Just to circle back, a pension fund is a perfect example of what I'm talking about here. If the pension fund manager only focuses on maximizing asset returns, they may take too much equity risk. But pension funds also have liabilities, payments they owe to retirees. Those liabilities may behave more like bonds. So the right risk management approach must consider both assets and liabilities together. That is enterprise thinking. Now, the same idea applies to individuals. Risk should be managed based on overall life goals, career income, savings, liabilities, time horizon, and life cycle needs. Suppose a person works in real estate and also invests heavily in real estate stocks. On paper, maybe the portfolio looks fine if viewed alone. But if the person's job, income, and investments are all tied to real estate, then total wealth is highly exposed to the same risk. That is not holistic risk management. So ERM is about stepping back and saying, let's look at the full picture. Now, next piece, risk infrastructure. Risk infrastructure means the people and systems needed to measure and track risk. This includes risk capture systems, databases, models, scenario and stress tools, reporting systems, and skilled personnel. In plain English, infrastructure is the machinery behind risk management. You need data, you need systems, you need models, you need people who understand those models, and very importantly, you need reports that decision makers can actually understand. All right, now let's connect the framework to the actual risk management process. So far, we have talked about the structure, governance, infrastructure, people, systems, policies, and all that. But now the important question is, once the framework exists, what actually happens inside it? This is where the risk management process comes in. At the enterprise level, the process usually starts from the top. The governance body, usually the board, sets the broad goals of the organization. They decide what the firm is trying to achieve, how much risk it is willing to take, and how that risk should be allocated. In simple words, the board says, here is where we want to go, and here is how much risk we are willing to accept on the journey. And that matters because management should not just wake up one morning and say, you know what, let's take a huge risk today. Feels exciting. No, management must execute strategy within the limits set by governance. So the board sets the risk tolerance and the risk budget, and management then runs the business in a way that stays consistent with those limits. Now, after goals and limits are set, the firm identifies and measures risks. This is where we ask, what risks are we actually facing? Market risk, credit risk, liquidity risk, operational risk, legal risk, currency risk, interest rate risk, and then we measure them because just saying we have risk is not very useful. That is like saying, I may be hungry later. Okay, but how hungry? Snack hungry? Full pizza hungry? There is a difference, right? Same in risk management. A company must estimate how large the exposure is. What happens if rates rise? What happens if the currency moves? What happens if sales fall? What happens if a borrower defaults? And then the firm monitors risk levels. And this part is very important. Risk is not something you measure once and then put in a nice PDF report and forget forever. Risk changes, markets change, portfolios change, business conditions change. A position that was within limits last quarter may be outside limits today. For example, a company that looked financially strong may become stressed after a recession, or a bond portfolio that looks safe may become more sensitive when interest rates move sharply. So risk has to be monitored continuously. Now, if exposures are outside limits, the organization must take action. So this is risk mitigation. Now, what might a company do in response? Well, it could decide to reduce its position or perhaps hedge against the risk. Maybe the company reduces the position. Maybe it hedges. Sometimes it buys insurance. Maybe it changes financing. And sometimes it improves internal controls. The method depends on the type of risk, but the basic idea is the same. Bring the risk back in line with the organization's tolerance. So for the exam, remember, risk management is not just measurement. It also includes action. If a company measures risk beautifully but does nothing when risk becomes unacceptable, that is not good risk management. That is just expensive reporting. After risks are monitored and managed, risk levels must be reported and communicated. This sounds boring, but it is actually a huge part of good risk management. The right people need the right information at the right time. The board needs to understand major risk exposures. Management needs to understand whether the firm is operating within limits. Portfolio managers need to know whether exposures are changing. Because if risk information stays trapped in one department, it does not help decision making. Think of a bank where the risk team knows credit quality is deteriorating, but senior management does not act on it. That is a problem. Or an investment firm where one portfolio has taken too much exposure, but the information is not communicated clearly. Again, problem. And then comes strategic decision making. This is where risk management becomes more than a defensive tool. It actually helps the organization make better strategic choices. And finally, we have feedback loops. This is a very important idea. A good risk management system learns over time. It improves. It updates assumptions. It reviews what worked and what did not. Sometimes the system itself teaches you where it is weak. A stress test may look good on paper, but later you realize, we didn't make the scenario harsh enough. A model may work fine in normal markets, but miss something important when conditions change. So the process is not a straight line, it is more like a loop. Now let's bring this down to an individual. For an individual, the process is obviously less formal. Most people do not have a board of directors sitting at the breakfast table saying, "Today we will discuss your personal risk tolerance." Although honestly, maybe some people need that, for individuals, risk management starts with defining goals. What are you really trying to do with your money? Maybe you're saving for retirement, trying to buy a home, putting money aside for your kids' education, or just making sure your family can keep its life on track if things get rough. Once goals are clear, the individual chooses investments and identifies risks. For example, a young professional may take more equity risk because the time horizon is long. Someone close to retirement may care more about capital preservation and income stability. A person with unstable income may need a larger emergency fund. Someone with dependents may need life insurance. So the risk management process for individuals is goal-based and life cycle-based. And because individuals usually do not have formal risk systems, they often rely on advisors. A financial advisor may help identify risks, choose investments, manage insurance needs, and review the plan periodically. But here is the important point. Even if an advisor helps, the individual must stay informed and involved. You cannot outsource your entire financial life and say, "Wake me up when everything is perfect." No. The advisor can guide, but the individual still needs to understand the big risks and the overall plan. Then the individual monitors and manages risks. Life changes, income changes, family needs change, markets change, health changes, goals change. So the risk plan must be reviewed periodically. A portfolio that made sense at age 28 may not make sense at age 58. A person who was single may now have dependents, or a person who had stable income may now be self-employed. So risk management for individuals is also a continuous process. Now let's talk about the benefits of good risk management. First, it leads to better risk-return decisions. This is the heart of portfolio management. We are not just chasing return, we are asking whether the return is worth the risk. Good risk management helps firms and investors make more intelligent trade-offs. Second, it creates fewer surprises. Now, to be clear, fewer surprises does not mean no surprises. The market will still surprise you. Life will still surprise you. CFA Institute will also surprise you sometimes, usually with a very innocent-looking question that is not innocent at all. But good risk management means the organization has at least thought through possible bad outcomes. It has asked, what if, before the event happens? Third, it improves discipline and efficiency. When there are clear processes, limits, and responsibilities, people are less likely to make random emotional decisions. Fourth, it strengthens governance and communication. Everyone understands the risk limits, the reporting lines, and the decision process. The board knows its role, management knows its role, risk managers know their role. This reduces confusion, especially during stressful periods. And finally, good risk management improves reputation and value creation. Investors, clients, regulators, lenders, and business partners usually trust organizations that manage risk well. A company that is disciplined, transparent, and prepared is often viewed as more reliable. And over time, that can support value creation. So the big message of this part is simple. A risk management framework is not just a chart. It is not just a committee. It is not just a model. It is the full system that helps an organization or individual make better decisions under uncertainty. It brings together goals, risk tolerance, people, systems, measurement, monitoring, communication, and strategy. And for exam purposes, remember this: the framework should be tailored to the organization. It should not be copied blindly from somewhere else. A global bank, a pension fund, a small business, and an individual investor do not need the same level of complexity, but they all need the same basic logic. Know your goals, know your risks, measure them, monitor them, manage them, and keep improving. All right, that completes the risk management framework. Now we are ready to move deeper into risk governance, where we look at how the board and senior decision makers guide the entire risk management system. All right, now let's talk about risk governance. Think of risk governance as the adult in the room. Not the boring adult, but the sensible one who says, okay, yes, let's grow the business, but let's not accidentally burn the house down. In simple words, risk governance is the oversight function. It makes sure risk management supports the value of the whole organization, not just one department, one portfolio manager, or one excited team chasing short-term profits. So who does this? Usually the board. The board sets the big direction. What are we trying to achieve? How aggressive do we want to be? What risks are okay? What risks need to be reduced? And what risks are completely off the table? Like, let's say the folks in charge at a bank are fired up to hand out more loans and really ramp things up this year. That kind of ambition gets people excited, maybe even dreaming about bigger bonuses. But then the board steps in and reminds everyone, growth is great, but we need to keep our risk in check. We want to see progress, but not at the expense of the bank's long-term stability. So it's all about finding that balance between pursuing opportunities and making sure the organization stays healthy for the future. That is risk governance. It does not mean don't take risk. It means take risk with boundaries. The board also defines risk appetite or risk tolerance. Basically, how much pain can the organization handle before things become dangerous? Now, a company may accept normal business risk from launching a new product. That's part of growth. But it may not accept a risk that could destroy liquidity, violate regulation, or damage reputation. And this discussion should happen before a crisis. After a crisis, everyone becomes a genius. Oh, we should have limited that exposure. Yes. Thank you, Captain Obvious. The point of governance is to have that conversation early. Risk governance also makes sure the firm follows regulations. Not glamorous, but very important. A great strategy that ends with fines, lawsuits, and angry regulators is not exactly a great strategy. Now, two important pieces here are the Risk Management Committee and the Chief Risk Officer, or CRO. The Risk Management Committee is where serious risk discussions happen regularly. Are we within limits? Are defaults rising? Is one department taking too much risk? Is the model missing something? It is basically the place where risk gets put on the table before it turns into a fire alarm. The CRO is the person formally responsible for building and running the risk framework. But a good CRO is not just the no person. The CRO should not walk into every meeting like no fun allowed. A good CRO helps the business take smart risk. They challenge weak assumptions, ask uncomfortable questions, and make sure management is not confusing luck with skill. So the key idea is that risk governance keeps risk-taking connected to the organization's goals. It gives management room to act, but not room to go wild. Now, let's say the same bank wants to lend more to small businesses. The board allows growth, but sets credit limits. The risk committee watches loan quality. The CRO notices defaults rising in one sector and says, hold on, this part is getting hot. See? Management tightens lending standards before the problem becomes ugly. That is risk governance in real life. It does not stop the bank from growing. It stops growth from turning into a disaster with a nice logo. All right, next we move to risk tolerance. Basically, how much risk the organization can actually take without putting itself in serious trouble. Now, before we move on, just a quick reminder, the PDF you're seeing is from the FinQuiz Battle Ready Summary. And this is exactly why these summaries can be so helpful near exam time. A topic like risk governance can feel wordy in the curriculum, but when it is organized visually, you can see the whole logic in one shot: board, risk appetite, committee, CRO, and oversight. So if you want this kind of clean structure for revision, check the FinQuiz products through the link in the description. Use the summaries with the notes, question bank, and mocks, because for this exam, understanding is step one, but repeated revision and practice are what make it stick. All right, now let's talk about risk tolerance. And this is one of those ideas that sounds simple, but it matters a lot. Risk tolerance basically answers this question: how much risk can an organization take before things get truly dangerous? Not just uncomfortable, not just earnings were a little messy this quarter. I mean the kind of loss that can threaten survival. So, risk tolerance is the maximum loss a firm can bear without putting the business at risk. It combines two things: willingness to take risk and capacity to take risk. And those two are not always the same. A company may be very willing to take risk, but if it does not have the financial strength to survive a bad outcome, then its real risk tolerance is not high. That is like someone saying, I can totally handle spicy food, and 2 bites later they're sweating, crying, and looking for milk. Confidence is not capacity. On the other hand, a very strong company may have the capacity to take more risk because it has stable cash flows, low debt, strong liquidity, and different sources of revenue. But the board may still choose to be careful because of regulation, reputation, or long-term strategy. So risk tolerance is not just about being bold. It is about strength, flexibility, and survival. A firm with higher risk tolerance is usually strong, flexible, and able to adapt quickly when something goes wrong. Think about Apple. Apple has a powerful brand, huge cash flows, a global customer base, and a very strong balance sheet. That does not mean Apple can take unlimited risk, of course, but it has more room to absorb shocks than a small company with weak cash flow and heavy debt. Now, how does a company determine risk tolerance? CFA Institute gives us two useful angles, the inside view and the outside view. The inside view means looking inside the company and asking, where are we weak? Is debt too high? Are cash flows unstable? Are we too dependent on one product, one supplier, one customer, or one market? A good example is Boeing. For a company like Boeing, internal weaknesses may include production quality issues, delivery delays, cost overruns, and operational problems. Those are not just little headaches. They can affect cash flow, reputation, regulatory pressure, and customer trust. The outside view means looking outside the company and asking, what could hit us from the environment? Interest rates, inflation, recession, regulation, supply chain disruption, currency movements, competition, all the stuff management cannot fully control. For Boeing, the outside view could include airline demand, fuel prices affecting airline customers, regulatory scrutiny from the FAA, supply chain pressure, and competition from Airbus. So good risk tolerance comes from putting both views together. What are our internal weak spots and what outside shocks could hit those weak spots? That is where real strategic risk thinking begins. Now, very important point, risk tolerance should be set before a crisis. Before, not during, not after. Because after a crisis, everybody becomes a genius. We should have reduced leverage. Yes, wonderful. But the kitchen is already on fire. Good governance means the board has that conversation when things are calm. What level of loss can we survive? Or what level of debt is too much? Or which risks are acceptable and which risks are just not worth it? And this is a board level responsibility, not just a management call. Now, we know management runs the business, management executes the strategy, but the board sets the guardrails. Why? Because management may face short-term pressure, higher sales, faster growth, better quarterly earnings, bigger bonuses. The board has to keep the long-term enterprise in view. Now, what drives risk tolerance? First, competitive position. A company with strong pricing power, loyal customers, and a strong market position can usually tolerate more risk than a company fighting just to stay relevant. Second, firm size. Larger firms often have more diversified operations and better access to capital. But size is not a magic shield. Big companies can still get into serious trouble if they take the wrong risks. Third, regulation. A bank, insurance company, or airline cannot think about risk the same way as a small private business. Regulators care because failure can hurt customers, employees, markets, and sometimes the wider economy. Now, how do firms test risk tolerance? One common tool is scenario analysis, and the idea is simple. What if this happens? What if sales fall? What if interest rates rise? What if a major supplier fails? What if regulators impose restrictions? Or what if customers pull back? The goal is not to predict the future perfectly. Nobody can do that. The goal is to see whether the company can survive under stressful but realistic conditions. For example, look at Southwest Airlines. An airline has to think carefully about fuel prices, travel demand, labor costs, aircraft availability, and debt. If management wants to expand routes or buy more aircraft, the board has to ask, okay, but what happens if fuel prices rise and passenger demand weakens at the same time? That kind of scenario helps determine whether the growth plan is within risk tolerance. So here is the big idea. Risk tolerance is the organization's danger line. It tells management, yes, take risks to create value, but do not cross this line. And that is what makes risk tolerance so important. It does not kill ambition. It keeps ambition from driving without brakes. All right, next we move to risk budgeting, where this broad idea of risk tolerance gets translated into actual risk allocation. All right, now we move from risk tolerance to risk budgeting. And think of it like risk tolerance tells us how much risk the organization is willing to take overall. Risk budgeting tells us where that risk is going to be used. So risk tolerance is the guardrail. Risk budgeting is the allocation. It is like a household budget, but instead of allocating money to rent, groceries, school fees, and vacations, we are allocating acceptable risk to different investments, business activities, asset classes, or risk factors. The key idea is risk budgeting translates strategy into actual risk allocation. A board can say, we are comfortable with moderate risk. Fine. But that statement alone does not help much until management turns it into something measurable. How much equity risk? How much interest rate risk? How much credit risk? How much currency risk? That is where risk budgeting comes in. So in portfolio management, risk budgeting means allocating acceptable risk using measurable metrics. It is basically the implementation of risk tolerance. For example, a pension fund may decide that it can take some equity risk because it needs long-term growth, but it cannot take too much liquidity risk because it has pension payments to make. So the risk budget may allow exposure to equities, bonds, real estate, and private assets, but with limits based on the fund's goals and liabilities. And this is important. Risk budgeting is neutral to hedging. It does not automatically require hedging, and it does not automatically reject hedging. It simply says, here is the risk we are willing to take, and here is how we are going to allocate it. Hedging is just one tool that may or may not be used to keep the portfolio within that risk budget. Now, one way to do risk budgeting is through single dimension measures. That means we look at risk using one main measure, such as standard deviation, beta, value at risk, or scenario loss. So the idea is to forecast the long-term risk and return characteristics of asset classes. So for each asset class, we estimate expected return, standard deviation, and correlation with other asset classes. Expected return tells us what we think the asset class may earn over time. Standard deviation gives us a sense of volatility. Correlation tells us how the asset class moves with other asset classes. And just to remind you, guys, correlation is a big deal in portfolio management because two assets may both be risky on their own, but if they do not move together, they can help reduce total portfolio risks. That is the whole diversification story. Now, how do we estimate expected returns? There are three common approaches. First, historical return analysis. We look at what the asset class has earned in the past. Useful, but not perfect. The past gives clues, not guarantees. Second, economic analysis. We think about growth, inflation, interest rates, productivity, business cycles, and the broader economy. Third, valuation models. These often build expected return as the risk-free rate plus risk premiums. So instead of just saying stocks returned this much in the past, we ask what return should investors require today for taking equity risk, credit risk, liquidity risk, or other risks. Now, that is more analytical and more CFA style. Okay? Now, risk budgeting can also be multi-dimensional. This is where we stop looking at the portfolio only through traditional labels like stocks, bonds, and commodities. and we start looking at the real sources of risk underneath. For example, a portfolio may look diversified because it owns equities, high yield bonds, real estate, and private equity, but underneath, a lot of that risk may still be tied to economic growth and equity market conditions. So on paper, it looks diversified. In reality, it may be wearing different outfits but dancing to the same music. That is why multidimensional risk budgeting is useful. One approach is by asset class risk, like equity risk, fixed income risk, commodity risk, and so on. Another approach is factor-based. Here we allocate by risk factors such as value, growth, size, momentum, credit, duration, inflation, currency, etc. The goal is to understand which risk premiums the portfolio is actually exposed to. Now, think CalPERS is a large U.S. pension fund. It does not just think, let's buy some stocks and bonds and call it a day. A fund like that has to think about long-term expected returns, volatility, correlations, liquidity needs, liabilities, inflation exposure, and how much total risk is acceptable for the plan. That is risk budgeting in practice. Now, let's recap. Risk tolerance says, how much risk can we take? Risk budgeting says, okay, where exactly are we putting that risk? And for the exam, keep this clean in your head. Risk budgeting is not about spending money on hedges. It is about allocating risk using measurable risk characteristics. So if risk tolerance is the speed limit, risk budgeting is deciding how fast each part of the business or portfolio is allowed to drive. All right, next we move into identifying risk. Financial and non-financial risks, where we start naming the actual risks organizations and individuals face. Up to this point, we've been talking about the process, the framework, governance, tolerance, and budgeting. In other words, we've been building the house. Now we're walking inside and asking, okay, what can actually go wrong here? And CFA Institute divides risks into two broad groups: financial risks and non-financial risks. Financial risks come from financial markets, things like stock prices, interest rates, exchange rates, commodity prices, credit spreads, and market liquidity. Non-financial risks come from operations, contracts, laws, regulations, people, systems, models, weather, cyber issues, and the broader external environment. Now, don't get confused by the name non-financial. These risks can still cost a lot of money. A legal problem, a cyber attack, a broken internal process, or a regulatory fine can absolutely hit profits and shareholder value. The label simply means the risk does not begin directly from financial market price movements. So let's start with financial risks. The first one is market risk. This is the risk from movements in market prices, interest rates, stock prices, foreign exchange rates, and commodity prices. Think about Tesla's stock price moving sharply because of investor expectations. Think about a bond portfolio losing value when interest rates rise. Think about Delta Airlines being affected by fuel prices. Think about Coca-Cola earning money globally and being exposed to currency movements. All of that is market risk. The next one is credit risk. This is the risk that a borrower, bond issuer, or counterparty fails to pay what they owe. Let's say if JP Morgan lends money to a company and that company defaults, JP Morgan faces credit risk. If an investor buys a corporate bond and the issuer cannot make interest payments, that is credit risk. It is basically the risk of, hey, you promised to pay me, and now you can't. Simple idea, big consequences. Then we have liquidity risk. This one is very important and candidates sometimes underestimate it. Liquidity risk is the risk that you may be forced to sell an asset below fair value, especially when markets are stressed or when your position is too large. A stock like Apple is usually very liquid. You can buy or sell shares pretty easily, but a small private investment, a thinly traded bond, or a large block of shares may be harder to sell quickly without taking a price cut. And here's the tricky part. Liquidity is usually there when you don't need it and disappears when you desperately need it. Classic market behavior, very polite until things get ugly. Liquidity risk can be driven by illiquid assets, a decline in overall market liquidity, or simply holding a position so large that selling it moves the price against you. Low liquidity can sometimes create opportunity because less followed assets may be mispriced, but it also comes with higher transaction costs and more uncertainty. So again, risk and opportunity are sitting at the same table. Now, another risk is solvency risk. Solvency risk is the risk that the firm runs short of cash and cannot continue operating or meet obligations. This is more serious than just our asset price moved against us. This is survival territory. Think about what happened to Lehman Brothers in 2008. The issue was not only that assets lost value. A major problem was that confidence collapsed, funding dried up, and the firm could not keep operating. That is solvency risk showing its teeth. So market risk, credit risk, liquidity risk, and solvency risk are the major financial risks in this section. Now let's move to non-financial risks. First is settlement risk. This is the risk that one party fails to complete the transaction at settlement. In plain English, one side does what it is supposed to do, but the other side does not. Then we have legal risk. This is the risk that contracts may not be enforceable or the firm may face lawsuits. A company may believe a contract protects it, but if the contract is unclear, illegal in some jurisdiction, or challenged successfully in court, that creates legal risk. In business, sometimes the small print turns out to be not so small after all. Next is compliance risk. This is the risk of violating laws or regulations. It includes regulatory risk, accounting risk, and tax risk. For example, a bank that fails to follow anti-money laundering rules may face major fines. And a company that misapplies accounting rules may need to restate earnings, or a multinational firm may face tax penalties if it gets tax treatment wrong. Not exciting topics, but in real business, these can be very expensive. Then we have model risk. This is one of my favorites because it sounds technical, but the idea is very human. Using the wrong model or using the right model in the wrong way. For example, if an analyst values a company using a constant growth model when growth is clearly unstable, that is model risk. The model may look clean, the spreadsheet may look beautiful, but the answer can still be nonsense. Excel does not know you made a bad assumption. It will calculate confidently anyway. That is why judgment matters. Next is tail risk. Tail risk means extreme events are underestimated. The model assumes the really bad outcome is almost impossible, and then the almost impossible event shows up on a Tuesday morning. Financial markets have a long history of events that models treated as extremely rare. The problem is not that models are useless. The problem is that models can make us too comfortable if we forget that real markets have fat tails and messy behavior. Then we have operational risk. This is the risk from failed people, processes, systems, or internal controls. A rogue trader is a classic example, and a cyber attack is another. A system outage, a processing error, an employee mistake, fraud, weak controls, these are operational risks. Like, Think about Wells Fargo's fake accounts scandal. That was not simply market risk or credit risk, it was a breakdown in conduct, incentives, controls, and governance. That is operational risk with a reputational cost attached. And finally, we have external risks. These come from outside events such as weather, natural disasters, terrorism, pandemics, or other major disruptions. For example, hurricanes can affect insurance companies, utility companies, airlines, retailers, and supply chains. And you might have observed COVID-19 affected travel, restaurants, commercial real estate, healthcare systems, and global supply chains. External risk can hit from the outside, but firms still need to plan for it. Now let's talk briefly about individuals. Individuals also face risk, but the names feel more personal. Health and disability risk can affect income. If someone cannot work, cash flow changes immediately. Now, mortality risk is the risk of dying early, which can create financial hardship for dependents, while longevity risk is the opposite problem, living longer than expected and outliving savings. And honestly, that is a very real retirement planning issue. Living a long life is wonderful, unless the money runs out halfway through the movie. Then we have property and casualty risk, damage to home, car, personal property, or liability from accidents. So firms face financial and operational risks. Individuals face life, income, health, and wealth-related risks. And the key takeaway is that both firms and individuals must integrate these risks into decision-making. So a company should not look only at expected profit and ignore liquidity, legal, cyber, and operational risk. And similarly, an individual should not look only at expected portfolio return and ignore factors like health, income stability, insurance needs, emergency savings, and retirement horizon. So, folks, risk management works only when the whole picture is considered. And for the exam, keep the distinction clean. So the big idea in this section is simple. Before you can manage risk, you have to name it correctly. If you misidentify the risk, you may use the wrong tool. Like, you don't fix a legal risk with a stock hedge, right? Or you don't fix a health risk problem with a beta calculation. You don't fix weak internal controls by saying, well, our expected return looks good. That would be like bringing a calculator to a fire. So identify the risk first, then measure it, then choose the right management response. All right, next we move into how these risks interact. Because in the real world, risks usually don't arrive one at a time. They like to travel together. Now, this is a really important section, and it is also very real world. So far, we've been naming risks one by one, like market risk, liquidity risk, operational risk, legal risk, and so on. But in real life, risks usually don't sit politely in separate boxes. They talk to each other. Actually, they don't just talk, they sometimes gang up. That is the core idea here. Risks do not occur in isolation. One risk can trigger another risk or make another risk much worse. And this is exactly why risk management is not as simple as saying, okay, we measured market risk, we measured credit risk, we measured liquidity risk, and we're done. No, not quite, because the real danger often comes from the way risks interact. Let's take a common chain. Market risk can lead to credit risk, and credit risk can lead to operational risk. Suppose the market drops sharply. That is market risk. Now, because asset prices fall, some borrowers or counterparties become financially weaker. That creates credit risk. Then, when those counterparties start missing payments or disputes arise, the firm has to process claims, handle settlements, update systems, and contact legal teams and manage internal procedures. Now, operational risk enters the picture. So one shock starts in the market, but the pain spreads through the system. That is how risk often works. It starts in one place, but it doesn't stay there. Another simple interaction is between credit risk and settlement risk. If one party is financially weak, the risk that it fails to deliver cash or securities at settlement becomes higher. So credit risk and settlement risk are connected. If the counterparty is shaky, settlement becomes shaky too. And then we have market or credit risk leading to legal risk. Now, this happens a lot when losses become large. When everybody is making money, contracts look beautiful. Everyone is smiling, handshakes, emails, nice lunches, all good. But when a big loss shows up, suddenly people start reading the contract very carefully. Wait, what does this clause mean? Can we challenge this? Was this enforceable? That is how legal risk can come out of market or credit losses. Now let's talk about wrong way risk. Wrong way risk happens when credit risk increases exactly when market conditions worsen. In plain English, the person who owes you money becomes more likely to default at the exact moment you need them to pay. Not ideal. That is like lending an umbrella to someone, and then when it starts raining, they say, "Actually, I lost it." Great timing, right? A classic example is a derivative contract. Suppose a company enters into a derivative with a counterparty. If the market moves in the company's favor, the counterparty now owes money to the company. But if that same market move also weakens the counterparty, then the company faces a problem. The contract is profitable on paper, but the counterparty may not be able to pay. So the market risk and credit risk are moving together in a bad way. The company is exposed exactly when the counterparty is weaker. That is wrong way risk. And this was a big issue during the 2008 financial crisis. Many institutions thought they had transferred or diversified risk, but when housing prices fell and credit markets froze, risks that looked separate suddenly became connected. Market losses, credit losses, liquidity problems, and counterparty concerns all started feeding into one another. That is why risk interactions can be so dangerous. The total risk can be much bigger than just adding up each individual risk. So we can say that 1 plus 1 does not always equal 2 in risk management. Sometimes 1 plus 1 equals 5, and sometimes it equals call an emergency board meeting. Now, the final point on the slide is also very important. Most models fail to capture risk interactions properly, and that makes sense. Models often need clean assumptions. They like neat categories, stable correlations, normal market behavior, and historical data. But real crises are messy. Correlations change, liquidity disappears, counterparties weaken, investors panic, legal disputes appear, operational systems get overloaded. The model may have measured each risk separately, but missed how they combine under stress. That is why scenario analysis and stress testing are so useful. They force management to ask, okay, not just what happens if one thing goes wrong, what happens if several things go wrong together? For example, think about a U.S. regional bank. Interest rates rise, so the value of some bond holdings falls. That is market risk. So what happens next? Depositors get nervous and start pulling money. Now liquidity risk appears. The bank may need to sell assets at a loss. And that worsens capital pressure. Credit risk may rise if borrowers also get stressed. And if communication is poor, reputational risk kicks in too. That is not one risk. That is a chain reaction. So for the exam, keep this section simple but sharp. Risks interact. One risk can trigger another. Wrong way risk is when credit risk gets worse as market conditions get worse. And risk models often miss these relationships, especially in stressed markets. Now, what's the conclusion? Risk management must look at the whole picture, not just individual risks sitting in separate folders. Because in the real world, risks rarely arrive alone. They usually bring friends. All right, now we're moving into one of the more technical parts of the reading, measuring and modifying risk. And the basic idea is very simple. Before you manage a risk, you need to understand what is driving it and how big it is. You can't just say, we have risk. Okay, thanks. But what kind of risk? Where is it coming from? How much damage can it cause? Is it normal day-to-day volatility, or is it the kind of risk that can knock the organization sideways? That is why this section starts with risk drivers. A risk driver is the underlying factor that creates the risk. Risk usually begins at the macro level, then moves through the industry and finally hits the company or portfolio. For example, interest rates rise. That is a macro level driver. Then banks, real estate companies, utilities, and highly leveraged companies feel the pressure in different ways. After that, each individual company is affected based on its own balance sheet, debt structure, pricing power, and business model. So risk does not just appear out of nowhere. It usually travels through the system. Economic conditions matter, and government policies matter. So tax rules, regulation, monetary policy, fiscal policy, all of these can change the risk environment. If the Federal Reserve changes interest rates, that can affect bond prices, mortgage rates, bank lending, equity valuations, and consumer spending. One policy change can ripple through a lot of portfolios. That is why systematic risk often comes from macroeconomic uncertainty and central bank uncertainty. It is not company specific. It affects broad markets. Now, once we understand the drivers, we need risk measures. The most basic measure is probability. Probability simply tells us the likelihood of an outcome. For example, what is the probability that a borrower defaults? Or what is the probability that returns fall below a certain level? What is the probability that interest rates rise? But probability alone is not enough. If I say there is a 5% chance of loss, the next question is loss of what size? A 5% chance of losing $100 is one thing. A 5% chance of losing half the company is a very different conversation. Same probability, completely different blood pressure. So we need measures that tell us not only how likely something is, but also how serious it could be. Now, that brings us to standard deviation. Standard deviation measures the dispersion of returns. In simple words, it tells us how spread out the returns are around the average. The more spread out the returns, the higher the risk. Under a normal distribution, about 68% of observations fall within plus or minus one standard deviation. About 95% fall within plus or minus two standard deviations, and about 99% fall within plus or minus three standard deviations. Now, that sounds neat and tidy, and finance loves neat and tidy, but real markets are often not that polite. Standard deviation has limitations. It is not always suitable when returns are not normally distributed, especially when there are fat tails. In real markets, extreme losses can happen more often than the normal distribution suggests. Also, standard deviation may overstate risk in a diversified portfolio because part of total risk can be diversified away. That is why, for well-diversified equity portfolios, beta becomes important. Now, Beta measures sensitivity to market movements. It tells us how much systematic risk an asset contributes. So if a stock has a beta greater than 1, it tends to move more than the market. If beta is less than 1, it tends to move less than the market. Beta is not measuring total risk. It is measuring market-related risk, the part that matters in a diversified portfolio. Now, derivatives have their own risk measures, often called the Greeks. Like delta measures price sensitivity to small changes in the underlying asset. Think of delta as if the stock price moves a little, how much does the option price move? And gamma measures the change in delta, so gamma becomes more important when the underlying price moves more sharply. Vega measures sensitivity to volatility. If expected volatility changes, option prices can change even if the underlying price does not move much. Rho measures sensitivity to interest rates, so the Greeks help us understand derivative risk more precisely. And yes, the names sound like a fraternity meeting, but for derivatives, they matter. For fixed income, one major risk measure is duration. Duration measures sensitivity to interest rate changes. If interest rates rise, bond prices generally fall, and duration helps estimate that sensitivity. Now let's move to loss-based measures. The big one here is VAR, value at risk. Value at risk tells us the minimum expected loss at a given confidence level over a given time period. For example, if a bank says it has a one-day VAR of $3 million at 5%, that means the bank expects to lose at least $3 million in one day, 5% of the time. And here is the word candidates must notice: minimum. Value at risk does not say the maximum loss is $3 million. It says losses may be at least $3 million in that tail of the distribution. The actual loss could be worse, much worse. That is why VAR can be dangerous if people misunderstand it. It may create a false sense of comfort. Someone may say, our VAR is only $3 million. Okay, but what happens beyond that? VAR does not fully answer that question. Now, this value at risk measure has several limitations. It depends on the model and inputs. It is sensitive to distribution assumptions. It shows only the minimum loss in the tail, and it can understate tail risk. That is why we also use CVaR or conditional VAR. CVaR looks beyond VAR and asks, once we are in the bad tail, what is the average loss? That makes conditional VAR a better tail risk measure because it focuses on the severity of losses after the VAR threshold has been crossed. Then we have LGD, loss given default. This is used in credit risk. It tells us the expected loss if a borrower defaults. For example, if a company defaults on a bond, investors may not lose 100%. They may recover some amount. LGD focuses on the loss after considering recovery. Now let's talk about scenario analysis and stress testing. Here we're going to talk about scenario-based and credit risk management, and this is a very practical part of risk management. This is where risk managers stop saying, okay, what does the average model say? And start asking a much better question: what could go wrong and how ugly could it get? So first, let's talk about scenario-based risk tools. The first tool is scenario analysis. In simple words, scenario analysis means we create a few possible situations and then ask, what would happen to our portfolio, company, or investment if this situation actually occurred? For example, suppose a bank is looking at its loan portfolio. It may ask, what happens if interest rates rise sharply? What happens if unemployment increases? What happens if the real estate market falls by 20%? These are not random guesses. These are carefully designed situations that help managers understand where the weak spots are. A good way to think about scenario analysis is like a fire drill. The building is not actually on fire, but you still want to know whether people can get out safely. In the same way, the company is not necessarily in trouble today, but management wants to know how it would behave under different possible conditions. Now, the second tool is stress testing. Stress testing is like scenario analysis, but with the volume turned way up. It focuses on extreme, rare, but possible events. Not normal bad days, really bad days. Think about 2008 during the global financial crisis, or think about the COVID market crash in 2020, or imagine oil prices collapsing, interest rates jumping, or a major customer suddenly defaulting. These events may not happen often, but when they do happen, they can hit very hard. So in exam language, remember this distinction. Scenario analysis looks at defined possible situations. Stress testing looks at extreme and rare events. Same family of tools, but stress testing is the tougher version. Now let's shift to credit risk measurement. Credit risk is basically the risk that a borrower may not pay back what they owe. That borrower could be an individual, a company, a government, or even another financial institution. So when we measure credit risk, we are trying to answer a very simple question. Can this borrower actually pay us back? And to answer that, analysts use several measures. First, we look at liquidity ratios. Liquidity ratios focus on short-term obligations. In plain English, can the company pay the bills that are coming due soon? Think about a company like Walmart. It has suppliers, employees, rent, utilities, and short-term debt payments. Even if Walmart is a huge company, analysts still care about whether it has enough cash and near-cash assets to handle short-term obligations. Liquidity is about survival in the near term. Next, we look at solvency ratios. Solvency ratios are more about the long-term ability to meet interest and debt payments. So liquidity asks, can you pay your bills this month? Solvency asks, can you survive financially over the long run? Let's say a company may look fine today but still carry too much debt for the future. That is why lenders do not just look at cash in the bank. They also ask whether the company can keep servicing its debt year after year. Then we have profitability. Profitability tells us about the company's earnings strength. This matters because profits are the engine that helps a company repay debt. For example, Apple generates huge profits, so lenders generally view it as financially strong. But if a company has weak or unstable earnings, lenders may become nervous because repayment depends on future cash flow. No profits, no comfort. Simple as that. Now, next is leverage. Leverage compares debt with equity and helps us understand the company's debt capacity. In everyday language, leverage tells us how much of the business is being financed with borrowed money. A little debt can be useful. It can help a company grow, but too much debt can make the company fragile. It is like carrying a heavy backpack while climbing a hill. A small backpack is fine. A very heavy one slows you down, and if the weather turns bad, you may be in real trouble. Then we have PD, or probability of default. This is exactly what it sounds like. It estimates the chance that the borrower will fail to make required payments. If a borrower has a higher probability of default, lenders will demand a higher return, charge a higher interest rate, or may avoid lending altogether. For the CFA exam, do not overcomplicate PD. Just remember, PD measures the likelihood that the borrower defaults. Next, we have CDS spreads. A CDS or credit default swap is like insurance against default. The CDS spread gives us a market signal of default risk. When investors think a company's credit risk is rising, its CDS spread usually widens. So if the CDS spread on a company jumps, the market is basically saying, hey, we are getting more worried about this borrower. It is like the market's warning light flashing on the dashboard. Finally, we have credit VAR and rating migration risk. Credit VAR estimates potential losses from credit risk over a given period at a certain confidence level. It is similar in spirit to regular VAR, but here the focus is credit-related losses. Now, rating migration risk is the risk that a borrower's credit rating changes, especially gets downgraded. For example, if a company moves from an A rating to BBB, its bonds may fall in value because the market now sees it as riskier. And that is important because the borrower does not have to default for investors to lose money. A downgrade alone can hurt bond prices. That is a key exam point. So, big picture, scenario analysis and stress testing help us ask, what could happen? Credit risk measures help us ask, can the borrower pay us back? Together, these tools give risk managers a more complete view of the risks sitting inside a portfolio or a company. Now let's talk about measurement challenges, because in risk management, not all risks are equally easy to measure. Some risks are like checking the weather app. Others are like trying to predict which uncle at a wedding will start an argument after dinner, possible, but not exactly clean data. Let's start with market risk. Market risk is usually the easiest to measure because we have a lot of data. Stock prices, bond yields, exchange rates, commodity prices, these are traded every day, sometimes every second. So if you want to study how Apple's stock price moves or how Treasury yields changed over the last 10 years, you have plenty of historical information. That does not mean market risk is perfectly predictable. Markets can still surprise you, but at least analysts are not completely flying blind. They have charts, prices, returns, volatility, correlations, all the usual tools. Now compare that with credit risk. Credit risk is harder to estimate because default is a rare event. Most borrowers do not default every month. A company either keeps paying, and then one day, maybe it runs into trouble. So the data is much thinner. Think about a major company like General Electric. For decades, many investors viewed it as a strong blue chip name. But over time, its financial strength weakened, and its credit rating was downgraded. The warning signs did not appear as neatly as daily stock price changes, right? So, credit problems often build slowly, and then the market suddenly says, wait a minute, this company is not as safe as we thought. That is what makes credit risk tricky. You are often estimating the probability of something that does not happen very often, but when it does happen, it really matters. And then we have operational risk, which is usually the hardest to measure. Operational risk comes from failed systems, human mistakes, fraud, cyber attacks, legal problems, bad processes, or internal control failures. These events are low frequency but high impact. In plain English, they do not happen every day, but when they happen, somebody is having a very bad Monday morning. Think about Wells Fargo and its fake accounts scandal. That was not a normal market movement. That was not simply a borrower failing to repay a loan. It was a breakdown in internal controls, incentives, oversight, and culture. Or think about a major airline system outage. The company may have strong revenue and loyal customers, but one technology failure can create delays, refunds, reputational damage, and regulatory pressure. The problem is that operational risk does not always come with a nice, clean spreadsheet. You cannot just say, show me the last 500 cyber attacks exactly like this one. Every event has its own flavor. Different systems, different employees, different controls, different mistakes. So when we measure these risks, especially credit risk and operational risk, we often need subjective judgment. That means management and analysts must use experience, professional judgment, assumptions, and sometimes external data. External data means looking beyond the company's own history. For example, a bank may not have experienced a major cyber breach itself, but it can study cyber losses at other banks. An airline may study past outages across the industry. A lender may use default data from rating agencies or industry databases. So the exam takeaway is simple. Market risk is generally easier to measure because data is abundant. Credit risk is harder because default is rare. Operational risk is usually the hardest because events are low frequency, high impact, and often unique. Now, guys, what you're seeing on screen is our battle ready summary. This summary can save you a lot of time during review. This risk management module has a lot of small moving parts: market risk, credit risk, operational risk, scenario analysis, stress testing, ratios, and so on. In the full curriculum, these ideas can feel scattered, but in the battle ready summary, we bring them together in a clean, exam-focused way so you can see the full picture quickly and remember what actually matters on exam day. So if you want a faster, more organized final review, check out the FinQuiz Battle Ready Summary. The purchase link is in the description below. It is built for candidates who want to revise smart, stay focused, and avoid getting lost in the noise. All right, now we move from measuring risk to modifying risk. And this is where candidates sometimes make one very common mistake. They hear risk modification and immediately think, okay, reduce risk. Not always. Risk modification does not always mean reducing risk. Sometimes it means reducing risk, yes, but sometimes it means rebalancing risk. And occasionally it may even mean increasing risk if the portfolio has become too conservative for its objective. For example, suppose a portfolio is supposed to maintain 60% in equities and 40% in bonds. Now imagine equities fall sharply and the portfolio becomes 45% equities and 55% bonds. The portfolio is now less risky than intended. So risk modification may involve buying equities to bring the portfolio back to the target risk level. So the real goal is not less risk. The real goal is the right risk. Now, that's a classic CFA style approach. Now, when we reduce risk, we often use the word hedging. A hedge is basically a transaction or strategy used to reduce risk. Sometimes a hedge can remove risk almost completely. Other times it only reduces part of the exposure. Think of an airline like Southwest Airlines. If fuel prices are a major cost, the airline may use derivatives to hedge some fuel price risk. It may not remove all risk, but it can reduce the damage if fuel prices move sharply against the company. Now let's talk about the first category: risk prevention and avoidance. This means avoiding the risk entirely. Sounds clean, right? Just don't take the risk. Problem solved. Well, not so fast. Avoiding risk usually comes with a cost. Sometimes that cost is money. Sometimes it is time. Sometimes it is flexibility. And sometimes it is opportunity. Think about a company like Apple deciding whether to launch a new product category. Any new product involves risk: customer acceptance, supply chain problems, cost overruns, competition, regulatory issues. Apple could avoid all that by never launching anything new. Very safe. Also very bad for long-term growth. So avoiding risk may protect you from loss, but it may also protect you from gain. That is the trade-off. The same applies to investors. If someone keeps all retirement savings in cash to avoid market risk, they may feel safe today. but over 20 or 30 years, inflation risk can quietly eat away purchasing power. So avoiding one risk may expose you to another. That is why risk avoidance decisions are usually made at the governance level. The board or governing body should decide which risks are simply not worth taking. For example, a bank may decide it will not lend heavily to a very risky sector because the potential return is not worth the possible default losses. Or a company may decide not to enter a country where legal and political risk is too high. That is risk avoidance. The exam may test this idea by giving you a tempting return and asking whether the firm should accept the risk. Remember, the answer is not always yes, just because expected return is high. If the risk is outside tolerance or outside the firm's expertise, avoidance may be the better choice. Now, let's move to risk acceptance. Risk acceptance means the firm decides to keep the risk. And that may sound passive, but it is not always careless. Sometimes accepting risk is the smart decision. Why? Because some risks are too costly to eliminate. Some risks are small enough to remain within tolerance. And some risks are part of the business model. Walmart accepts inventory risk. Or JP Morgan accepts credit risk. And ExxonMobil accepts energy price exposure. These risks do not disappear just because management would prefer a peaceful life. The point is to accept risk knowingly, not accidentally. Now, one form of risk acceptance is self-insurance. Self-insurance means the firm retains the risk internally instead of paying an outside party to take it. The firm may hold capital reserves or set aside funds to absorb potential losses. Banks are a good example. Banks hold capital and loan loss reserves because they know some borrowers may not repay. They do not insure every single loan externally. They accept part of that credit risk and prepare for it internally. So, what's the benefit? The benefit is lower external cost and more flexibility. The firm does not have to pay an insurer for every risk. But there is a catch, and it is a big one. Self-insurance must stay within risk tolerance. If a firm says we are self-insuring, but the possible loss could seriously damage or destroy the business, then that is not smart self-insurance. That is just denial with a business card. So for the exam, be careful. Self-insurance is acceptable only when the retained risk fits the organization's risk tolerance and financial capacity. Now, another form of accepting risk is diversification. Diversification does not eliminate risk, but it spreads risk across different investments, businesses, customers, suppliers, or regions. For example, a mutual fund that owns hundreds of stocks is less exposed to the failure of one company than a portfolio that owns only 2 or 3 stocks. If one holding disappoints, the whole portfolio does not collapse. Or think about a company like Procter & Gamble. It sells many consumer products across many categories and countries. That diversification can reduce dependence on one product, one brand, or one market. But diversification has limits. It works best when combined with other risk strategies. In a broad market crash, even diversified portfolios can fall. And during a recession, many businesses may suffer at the same time. So diversification is powerful, but it is not magic. And that is a nice exam point. If the question implies that diversification eliminates all risk, be careful. Diversification mainly reduces unsystematic or company-specific risk. It does not remove broad market risk. Now, the governance insight here is very important. Risk avoidance and risk acceptance should both be clearly defined at the governance level and aligned with overall risk tolerance. This means the organization should know in advance which risks will we avoid, which risks will we accept, and how much risk are we willing to retain. Good firms do not make those decisions randomly in the middle of a crisis. They set the logic beforehand. A simple way to think about this section is this: if the risk is not worth taking, avoid it. If the risk is worth taking and within tolerance, accept it. If the risk is accepted but needs to be controlled, use tools like self-insurance and diversification. So, risk modification is about bringing risk exposure in line with the organization's goals and tolerance. Sometimes that means avoiding risk, sometimes accepting the risk, or sometimes it means retaining it internally, and sometimes it means diversifying it. But the worst approach is taking risk without knowing why. That is when risk management turns into gambling with PowerPoint slides. All right. Now let's finish this learning module with the last part of risk modification. Now we move into risk modification, transferring, shifting, and how to choose the right method. And this is actually a very common sense section. The basic idea is simple. Once you identify a risk, you have to decide what to do with it. Do you avoid it? Do you keep it? Do you transfer it to someone else? Or do you shift part of it using financial contracts? Think of it like owning a house. You cannot stop every bad thing from happening. A storm may damage the roof. A pipe may burst. A neighbor's tree may fall into your yard. So what do? You buy insurance for some risks, you fix some risks yourself, and for a few risks, you just say, okay, I can live with that. That is risk management in real life. Not glamorous, but very useful. In this section, we focus mainly on risk transfer and risk shifting. Let's start with risk transfer, and the easiest example is insurance. Insurance means passing risk to another party, usually through a legal contract between the insurer and the insured. The insured pays a premium, and the insurer agrees to cover certain losses if specified events occur. So when a company buys property insurance, cyber insurance, business interruption insurance, or liability insurance, it is not making the risk disappear from the universe. It is transferring the financial impact of that risk to the insurance company. For example, Walmart has thousands of stores, warehouses, employees, suppliers, trucks, and customers. It cannot say, nothing will ever go wrong. Come on, that is not a plan. That is a wish with a spreadsheet. Instead, large companies use insurance and risk management systems to protect themselves from losses that could damage operations. Now, insurers are not doing this out of kindness. They are not sitting there saying, we just love taking everybody's problems. No. They charge a premium and they manage their own risk by diversification. Now, insurers themselves also manage risk. They do not just collect premiums and hope for the best. An insurance company writes many policies across many customers, many regions, and many types of risk. The idea is that not everyone will have a claim at the same time. One house may burn down, but not every house in the portfolio should burn down together. That low correlation is what makes insurance work. For example, if an insurer covers thousands of homes in one coastal area and a major hurricane hits that exact region, losses may arrive all at once. That is why insurance companies care so much about diversification. Now, that's why we have reinsurance. Insurers also try to sell policies where the risks are not highly correlated. That word correlated is important. If every insured person suffers a loss at the same time, the insurer has a serious problem. Reinsurance is basically insurance for insurance companies. The insurer transfers part of its own risk to another insurance company. So if the original insurer faces a large loss, the reinsurer absorbs part of it. A simple way to remember it: insurance protects individuals and companies. Reinsurance protects insurers. It is like the insurer saying, I can handle some of this risk, but not the whole monster by myself. Now, insurance contracts usually have limitations. They do not cover every possible bad event. This is where candidates need to be careful. For example, some insurance policies may contain war clauses which exclude or nullify coverage in conflict zones. That means if the loss is caused by war or certain military actions, the insurer may not pay. Then there are moral hazard provisions. These are designed to prevent people from acting carelessly just because they are insured. For example, an insurance contract may exclude losses related to intentional damage, suicide, or self-destruction. The logic is simple. Insurance is not meant to reward bad behavior. And then we have deductibles. A deductible requires the insured party to pay an initial amount before the insurance company starts covering the loss. For example, if a policy has a $5,000 deductible and the loss is $30,000, the insured pays the first $5,000 and the insurer covers the rest, depending on policy terms. So, deductibles help reduce small claims and encourage better risk management. In simple words, if you have to pay the first part of the loss yourself, you are less likely to be careless. It is the financial version of don't throw your phone in the pool just because you bought a warranty. Now let's move to specialized bond types. The first one is a surety bond. A surety bond protects against the risk that a third party does not fulfill its obligation. Suppose a construction company is hired to build a school or a bridge. The project owner may require a surety bond. If the construction company fails to complete the work, the surety bond helps cover the loss or ensures performance. So the key idea is surety bond equals protection against failure of a third party to meet obligations. The second one is a fidelity bond. A fidelity bond covers losses caused by employee dishonesty. Think fraud, theft, embezzlement, or other dishonest acts by employees. Like, if a bank employee steals money or manipulates internal accounts, a fidelity bond may cover some of the loss. So remember, fidelity bond equals employee dishonesty. That is the exam-friendly association. Now let's shift, literally, to risk shifting. Risk shifting usually involves derivatives. Derivatives allow market participants to transfer certain financial risks to other parties. Common examples include forwards, futures, swaps, and options. Let's begin with forward commitments. A forward commitment is an obligatory contract. Both parties are locked into a future transaction at a pre-agreed price or rate. Once the contract is set, both sides must fulfill the agreement. Examples are forwards, futures, and swaps. Suppose Starbucks expects to buy coffee beans in 6 months and is worried that coffee prices may rise. It may use a futures or forward contract to lock in the price today. That reduces uncertainty. Starbucks gives up some flexibility but gains protection against a price increase. Now, that is the trade-off, and forward commitments are useful, but they are not flexible. Both parties are obligated. No just kidding button. Once you enter the contract, you have to perform. Also remember, these contracts generally do not require a large upfront cash payment like buying the asset immediately. That is one reason derivatives are widely used. Now compare that with options, also called contingent claims. Options are different because one party gets the right, not the obligation, to buy or sell. The option buyer pays a premium upfront for that right. So an option gives flexibility. You can use it if it helps you and walk away if it does not. That is why options are valuable. They protect you in one direction while allowing you to benefit in the other direction. Now, a call option gives the right to buy at a known price. If you exercise a call option, you pay the fixed price and receive the underlying asset. And a put option gives the right to sell at a known price. If you exercise a put option, you deliver the underlying asset and receive the fixed price. Here is a simple way to remember it. Call equals right to buy, put equals right to sell. Keep that clean in your head. The exam loves testing this, and it is one of those places where candidates lose easy points by rushing. For example, suppose an airline is worried that fuel prices may rise. It can use derivatives to manage that risk. A forward commitment may lock in fuel prices, while an option may provide protection if prices rise, but still allow the airline to benefit if fuel prices fall. That flexibility is the key difference. Options are like paying for a reservation with choices. Forward commitments are like signing the contract and saying, okay, we're doing this. One is flexible, the other is firm. Derivatives may trade on exchanges or privately over the counter, often called OTC. Exchange-traded contracts are more standardized, while OTC contracts can be customized between banks, dealers, and clients. Now, the last piece is how to choose which risk modification method to use. So, how do we choose among these methods? This is where candidates should slow down a bit, because the exam may give you a situation and ask which method is most appropriate. If a risk is outside the firm's core competencies and adds little value, prevention or avoidance usually makes sense. Let's say if a clothing retailer has no expertise in speculative currency trading, it may simply avoid that risk rather than pretend it is a hedge fund on the side, right? You know, it makes sense if a company has no expertise in a high-risk business line and the potential reward is not worth the distraction. The best answer may be don't take the risk. Avoid it. Now, if a company has large free cash flow and the risk is within tolerance, self-insurance may make sense. The firm can retain the risk internally because it has the financial strength to absorb losses. So, large companies sometimes do this for smaller or predictable losses because buying insurance for everything may be too expensive. For example, a company like Apple has massive cash resources. For many small risks, it may be more efficient to absorb losses internally rather than pay an insurer for every little exposure. But if the risk is highly correlated or difficult to insure, traditional insurance may not be suitable. Insurance works best when losses are reasonably independent across many policyholders. If everyone gets hit at the same time, the model becomes much harder. And if financial risks exceed risk appetite, derivatives may be the better tool, where available. For example, if an airline is worried about fuel price risk, or a company is worried about currency risk, or a borrower is worried about interest rate risk, derivatives can help shift that exposure. So the choice depends on cost, benefit, risk tolerance, the type of risk, and whether a suitable tool exists. There is no one perfect method. A company may use avoidance for some risks, self-insurance for others, insurance for property and casualty risk, and derivatives for currency or interest rate risk. Good risk management is not about picking one tool and using it everywhere. That would be like using a hammer for every repair and then acting surprised when the window breaks. The tool has to match the risk. So, the big judgment point is this. You do not choose the fanciest tool. You choose the tool that fits the risk. Like, reinsurance transfers risk from insurers to other insurers. Derivatives shift financial risk to market participants. Forward commitments create obligations. Options create rights. So folks, remember, risk management is not about sounding sophisticated. It is about asking, what kind of risk is this? How much can we tolerate? And what is the most efficient way to deal with it? Okay. Now, let's step back and close the full learning module. This reading started with a very simple but powerful idea. Risk is unavoidable. Every business, every investor, every portfolio manager, and every individual faces uncertainty. Markets move, companies change, cash flows surprise us, people make mistakes, models miss things, and sometimes several risks show up together like they came in the same Uber. But the goal is not to run away from risk. The goal is to choose the right risks, measure them, monitor them, and manage them in a way that supports the objective. That is the real message of this module. Risk management is not about being scared. It is about being prepared. It is not about saying no to every opportunity. It is about knowing which opportunities are worth the risk. Because folks, we can't eliminate all losses. That is impossible, but we can make sure losses are understood, tolerable, and consistent with the bigger plan. And as you revise this module, don't just memorize the terms. Ask yourself, what is the situation? What is the risk? How serious is it? Who should decide? And which tool fits best? That is how CFA Institute likes to test this reading. Not always by asking you to repeat a definition, but by seeing whether you can apply the logic. So, nice work getting through this module. Portfolio management can feel very conceptual at times, but this reading is practical. It is about how real firms and real investors survive uncertainty without hiding from opportunity. And honestly, that is a pretty good lesson beyond the CFA exam too. All right, that wraps up Introduction to Risk Management. Keep going, keep practicing, and keep building the kind of judgment that turns exam knowledge into real investment thinking. Good luck. See you in the next lecture. Until then, happy studying.